Right now, as we watch the tape live on this Tuesday morning, November 25th, 2025, Opendoor Technologies, Inc., ticker symbol OPEN, is trading at exactly $7.68. We are seeing a virtually flat, slightly negative intraday move, down just 1 cent or 0.13% on the session. The stock is pinned in a tight range, oscillating between 760 and 775, looking for direction. If you are just glancing at the quote screen, you see a red decimal and a stock that is largely unchanged from the open. You might think this is a dead money day for a company that the market has largely written off as a casualty of the post-pandemic housing bust. But if you turn away now, you are missing the single most complex and potentially explosive corporate engineering event happening in the small-cap tech space. The expectation, the lazy narrative you will hear from the mainstream financial press, is that Opendoor is a failed house flipper. They will point to the Q3 earnings miss we just saw, where revenue came in at $915 million, missing estimates. They will point to the $90 million net loss and tell you that iBuying is a broken business model that cannot survive in a high interest rate environment. That is the expectation. A zombie company, slowly bleeding out while waiting for the Fed to save the housing market. The reality? The reality is that Opendoor is executing one of the most aggressive stealth pivots in Silicon Valley history, transforming right before our eyes from a capital-heavy real estate investor into an AI-native software platform. The market is pricing this stock as if it still needs to buy billions of dollars of homes to survive. But the internal metrics from Opendoor 2.0 tell a different story. They are building an automated engine that has collapsed the cost of assessing a home from hundreds of dollars and days of work into pennies and minutes. And then there is the warrant dividend, that bizarre, confusing distribution of Series K, A, and Z warrants that hit accounts recently. Most retail investors are confused by them, but the institutional reality is that management just handed shareholders a free leveraged call option on their own turnaround. This isn't the behavior of a company preparing for bankruptcy, it is the behavior of a management team that believes the equity is so undervalued they want to force a repricing. Let's dissect the price action we are seeing today. The stock opened at $765, dipped to $760, and was immediately bought back up. This support level at $760 is critical. It represents the floor, established after the post-earnings sell-off earlier this month. The volume is lighter than usual, around 15 million shares traded so far, which suggests that the sellers who wanted out after the Q3 miss are gone. We are left with the true believers and the accumulators. The fact that the stock is holding steady despite the broader market choppiness indicates that the weak hands have been flushed. Now, we have to talk about the Opendoor 2.0 thesis, because this is where the Tesla stock comparison actually holds water. For years, Opendoor employed armies of people to inspect homes, estimate repairs, and manage contractors. It was a logistics nightmare. Under CEO Kaz Nejatian, they have ruthlessly automated this. They launched tools that allow a seller to walk through their house with a smartphone, and within 10 minutes, an AI model generates a firm offer. They reduced the number of humans needed in the underwriting flow from 11 to 1. This is not just cost-cutting, it is a fundamental change in unit economics. The market is still looking at the gross margin of the old business model. They aren't pricing in the contribution margin of the new software-led model, which is significantly higher. Let's address the elephant in the room. The Q3 2025 earnings. Yes, they missed the top line. Revenue was $915 million. The street wanted $922. But look closer at why. They deliberately slowed down acquisitions of bad inventory. In the past, Opendoor would buy anything to show growth. Now they are rejecting homes that don't fit their strict risk parameters. This discipline hurts revenue in the short term, but saves the company from catastrophic losses in the long term. The net loss of $90 million is ugly, sure, but a huge chunk of that is non-cash stock-based compensation and depreciation. The adjusted EBITDA burn is shrinking. They are inching toward that break-even target for late 2026, and the market is slowly starting to believe them. But the real story, the one that nobody is talking about correctly, is the warrant dividend. On November 22nd, shareholders received these tradable warrants. Series K with a strike of $9, Series A with a strike of $13, Series Z with a strike of $17. Why on earth would they do this? The expectation is that it's a desperate gimmick. The reality is that it's a brilliant anti-short strategy. By flooding the market with these warrants, they have created a complex arbitrage situation that makes it very dangerous to be short the common stock. If the stock rallies to $9, those Series K warrants effectively become new shares, yes, but they also create a massive buying frenzy, as warrant holders exercise or sell to market makers who must hedge. It aligns the retail shareholder with the management. If the stock doubles, you don't just win on the stock, you win on the warrants. It's a force multiplier for a squeeze. I want to pause right here and ask you guys directly because this is confusing a lot of people. Comment below. Did you receive the Opendoor warrants in your account? And more importantly, are you holding them as a lottery ticket or did you sell them immediately? I'm seeing a lot of mixed strategies on the forums and want to know what the real sentiment is. Now let's look at the marketplace or exclusives business. This is the part of Opendoor that looks like Zillow or Redfin, but better. Instead of buying the house, Opendoor connects the seller directly to a network of buyers, institutional investors, REITs, or even regular folks using SoFi Invest to buy a home. Opendoor takes a cut of the transaction, but takes zero risk on the asset. This asset-light segment is growing quietly. In a world where interest rates are stabilizing but still high, this is the holy grail. It transforms Opendoor from a capital-intensive flipper into a capital-efficient exchange. The expectation is that Opendoor is stuck with billions in debt to fund homes. The reality is that their reliance on that debt is decreasing as the marketplace mix increases. Speaking of interest rates, we are in late 2025. The Fed has cut rates, but mortgage rates are sticky. They haven't crashed back to 3%. They're hovering in the 6s. This is actually a Goldilocks zone for Opendoor. If rates are too low, 3%, houses sell so fast that nobody needs Opendoor. You just put a sign in the yard. If rates are too high, 8%, nobody moves. But in the middle, sellers are stressed. They need certainty. They can't afford to have a deal fall through because the buyer's financing failed. Opendoor offers that certainty. The value proposition of cash offer, close in 10 days, is arguably stronger now than it was in 2021. Competitively, the field has cleared. OfferPad is struggling to maintain liquidity. Zillow exited the iBuying game years ago, famously admitting their algos couldn't figure it out. Opendoor is the last giant standing. In platform economics, the last man standing usually takes the whole pie. They have the most data. They have the most transaction history. They have calibrated their pricing engine on hundreds of thousands of homes. This data moat is invisible on the balance sheet, but it is the reason Citadel or BlackRock might take a massive stake eventually. They know that data is the new oil, and Opendoor has the map of the U.S. housing market's pricing inefficiencies. If you are looking at investing sites or using your Fidelity mobile app to analyze the valuation, it's startling. Opendoor trades at a price-to-sales ratio of roughly 1.1. Zillow trades over 5 times sales. Redfin trades higher. The market is pricing Opendoor as if it is going bankrupt. But they just cleared their near-term debt hurdles through debt exchanges earlier this year. The bankruptcy risk for the next 12 months is virtually zero. So, you are buying a company with a $5 billion revenue run rate for a market cap that implies it is worthless. That divergence is the opportunity. However, we must respect the risk. The expectation of a housing recovery could be wrong. If we enter a deep recession in 2026 and unemployment spikes to 6 or 7%, Opendoor will get hurt. They own inventory. If home prices drop 5% in a month, their equity is wiped out on those homes. That is the leverage sword. It cuts both ways. Also, the Opendoor 2.0 software needs to work flawlessly. If the AI starts mispricing homes again like the old algos did, they will bleed cash rapidly. The margin for error is razor thin when you are flipping high-value assets. Let's look at the technicals on the chart. 750 is the line in the sand. Below that, we retest the sixes. But above $8, that is where things get interesting. The 50-day moving average is curling up. If we break $8, we trigger a gap fill toward the $10 level. And remember,